Imagine it's September 15th, 2008. People are waking up, drinking their coffee, and checking their emails. It feels like a perfectly normal Monday morning. Almost nobody realizes that the global financial system is quietly becoming unstable. Look at these digital tickers. This major disruption doesn't arrive with explosions or invading armies. It plays out entirely through red numbers and negative percentages flashing across computer screens. The catalyst is a 158-year-old investment bank called Lehman Brothers. Most of the public has never even heard of it. Yet by the end of the day, it will file for the largest bankruptcy in American history. Within hours, the fallout begins. Millions of jobs disappear and businesses lock their doors. Entire countries are pushed to the very edge of severe financial hardship. How does one single company possess the mechanical leverage to disrupt the entire global economy? To answer that, we have to look at how that company was wired into the rest of the world. In the early 2000s, American culture shifted. Buying a home stopped being a simple living necessity and became a reliable investment strategy. People believed prices would climb forever, and builders raced to construct endless neighborhoods of identical homes just to keep up with demand. To feed this intense demand, lenders started issuing what they called subprime loans. These were higher-risk mortgages approved for people with unstable incomes, people who had very little chance of reliably paying off their debt. Rather than holding on to these risky loans, financial institutions bundled thousands of these mortgages together into a single massive basket. Think of it like mixing weaker assets in with stronger ones and selling the entire package as if everything inside is perfectly healthy, completely hiding the individual risks. Wall Street sold these bundles as highly profitable, low-risk investments. Buyers lined up around the world, and these packages began to travel outward. Insurance companies, foreign governments, and pension funds eagerly bought in. They had unintentionally built a massive vulnerability. The entire global financial network was now firmly anchored to a foundation of weakening American housing debt. Nobody chased the profits of this system more aggressively than Lehman Brothers. They had survived the American Civil War, the Great Depression, and 2 world wars. That history created a deep, blinding sense of invincibility. Lehman executives confidently bought billions of dollars worth of these bundled mortgages. They assumed they were smarter than the market and could navigate the risks entirely on their own. Then, in 2007, housing prices stopped climbing. Homeowners started missing their monthly payments. A massive wave of defaults hit the consumer market, dragging down the value of those investment bundles. Because the weaker mortgages were completely hidden inside the stronger ones, nobody knew exactly how much any given bundle was actually worth. And if banks don't know the value of an asset, they don't know who is solvent. Overnight, financial institutions simply stopped lending money to each other out of pure fear. By the weekend of September 13th, 2008, Lehman Brothers is completely out of cash. Wall Street leaders and government officials hold frantic emergency meetings in New York, racing against the clock to find a buyer to take over Lehman and absorb their losses. The clock runs out. No deal is reached. The failure to secure a rescue proves that no institution, no matter how old or prestigious, can escape the math of its own troubled balance sheet. On the morning of September 15th, Lehman officially declares bankruptcy, and market panic spreads. Stock markets decline sharply. Global credit dries up in a matter of hours. Lehman acted as a critical support beam holding up thousands of other firms. When it is removed, the sudden loss of capital ripples outward, crashing into the surrounding institutions attached to it. To prevent a prolonged shutdown of the system, governments and central banks step in. They inject massive, unprecedented amounts of liquidity into the grid just to force the gears to keep turning. But the financial freeze translates rapidly into real-world consequences. Factories halt production. Small businesses reduce staffing levels. Millions watch their savings decline and face severe housing difficulties. This is the true architecture of a financial chain reaction. Removing a single node inside a Wall Street boardroom directly severs the economic lifelines of working families thousands of miles away. Economists still debate the role Lehman Brothers played. The reality is that Lehman did not cause the 2008 crisis on its own. The firm was simply the match dropped into a powder keg that had been forming for years. The true foundation of the downturn was a shared assumption. Millions of highly educated professionals, powerful global banks, and everyday investors all chose to believe the comforting mathematical idea that real estate values would continue rising indefinitely. The lasting effects of that belief are still visible today in local communities and independent storefronts that never had any connection to high finance. The global economy operates strictly on psychological trust. We trust our banks, we trust our markets, and we trust that the system will function tomorrow exactly as it functions today. When that belief breaks, the math stops working. True systemic failure rarely begins with panic. It is engineered over years by a collective, unshakable confidence that serious disruption is simply impossible.